thought about how the Reserve Bank of India figures out how much money to print? It's a fascinating process involving a mix of economic forecasting, robust systems, and strategic planning. At the heart of this process lies the Minimum Reserve System, or M.R.S., which has been the cornerstone of India's monetary policy since 1956. This system mandates that the RBI must always hold assets worth at least 200 crore rupees. Out of this, 115 crore rupees should be in gold, with the remaining 85 crore rupees in foreign currencies. Once this minimum is met, the RBI has the discretion to print more money as required. However, it doesn't do this arbitrarily. It needs the government's approval first. Point to note that India still relies on the minimum reserve system because of its significant advantages. The main aim of this system is to maintain a steady money supply in the economy, ensuring it stays stable without leading to inflation. Now, how does the RBI determine the amount of money to print? This is where the GDP comes into play. Gross Domestic Product, or GDP, is essentially the total value of all goods and services produced in the country within a year. Think a country as a giant market where people and businesses are constantly buying and selling things, cars, clothes, food, services, etc. GDP is like adding up the value of all these transactions to see how much economic activity is happening in that country. Now, first the predictions regarding the GDP for the upcoming year are taken into account. Government, the Center for Monitoring Indian Economy, and the RBI's research wing play a key role into it. Let's name this predicted GDP as A. Now, consider the amount of cash already with the RBI and banks, labeled as B. Then, there's the demand for replacing worn-out notes, which we'll call C. The total amount of money to be printed is calculated as A minus B plus C. And just to be on the safe side, an extra 5% is added for emergencies. This entire process undergoes stringent checks and verifications by regional offices and banks, and is consolidated at the Department of Currency Management Central Office in RBI, Mumbai. All of this is done in strict adherence to the RBI issue department manual and central office guidelines. Here is an interesting fact. RBI has the sole right to issue currency notes of various denominations except 1 rupee note under Section 22 of Reserve Bank of India Act. The 1 rupee note and coins are issued by the Ministry of Finance and it bears the signature of Finance Secretary. Printing money is a balancing act. The RBI can't afford to print too much because that could lead to inflation, causing prices to rise. Conversely, printing too little could hinder the economy's functioning and possibly prevent it from reaching the targeted GDP growth rate. In conclusion, the Reserve Bank of India's decision to print money is a complex process, underpinned by the minimum reserve system, economic forecasts, and strategic planning. It's a careful balancing act aimed at ensuring economic stability and growth while keeping a lid on inflation. What do you think of this process? Let us know in comments.